going to go over the more important things from chapter 6. So again, this chapter is all about reading, which you should be reading, obviously, the textbook. So it's really no need for me to go through a lot of the information that you can just read. So I'm going to go through some of the more difficult things. And I would encourage you to print out this and fill it in. I'm going to scroll down. I have the solution attached to it. So I would encourage you to fill it out on your own. Studies have shown that you learn better when you write it down yourself. So again, watching me do something really doesn't gain you anything except being a better spectator. So we're going to talk about merchandising activities. And again, a lot of these things I'm going to skip through. You can read. We all know what a merchandiser is. They sell merchandise. So this book will talk about a lot of that type of stuff. But what I need to contrast a merchandiser in accounting, we have separate, I guess, a focus between a merchandiser, a manufacturer, and a service business. And I'll get into those into a second. But the first thing that we're going to talk about is the operating cycle. And obviously the operating cycle for a merchandiser, a manufacturer, and a service business is going to be different. So the operating cycle for a merchandiser, if you think about it, is basically how long am I out my cash? So for instance, if you're going to buy t-shirts and you're going to sell those t-shirts, so let's say you buy 10 t-shirts for $10. So I have to come up with $100 cash to buy 10 t-shirts for $10. Then it takes me a while to sell those t-shirts, and let's say I'm going to sell them for $15. And if I sell them on credit and allow people a few days or a few weeks to pay for them, I'm not getting my cash back until a while later. So the time from the cash is out the door, from when I purchase it, to the cash comes back in my pocket, that's the operating cycle. And obviously we hope this is more than this. So if I sell all 10 of them at 15, I made $5 on each of them, so I get profit. But if I need the cash from the t-shirt sales before I can start the operating cycle again, especially for new businesses, this is a critical piece. So cash is out the door, I buy the inventory, I sell the inventory. So if it takes me 180 days to sell the inventory, I'm out of cash for 180 days plus however long it takes me to collect it. So it's a very important item in there. The operating cycle for a manufacturer is even longer because they have to buy, let's say I'm going to make my t-shirts, I have to buy the fabric, then I have to make the t-shirts, which takes me time, and then they're sitting in inventory, and then I have to sell them, etc. So I would add the manufacturing time to this. And for a service business, the operating cycle, I don't have inventory, so it's basically when I do the service and collect on the accounts receivable. So the operating cycle for a service business is much shorter. Now, if it takes you a while to do the service, that may be different. But if I'm out and I trim your trees or mow your yard, basically I do that, and then I either collect it there, so my operating cycle is very short, or I give you some time to pay. So that's the operating cycle is going to be different for that. So what happens is the income statement looks different for a merchandiser, a manufacturer, and a service business. I'm not going to put a manufacturer on this one because that's actually covered in managerial accounting, which is the next semester. So this is the first semester of accounting. The second semester of accounting gets into manufacturing, mainly because it's a longer operating cycle and has different types of inventories. But for a service business, that's basically this over here. My income statement lists all my revenues, subtracts my expenses, I get net income. For a merchandiser, it's very similar to a business, but what happens is they call this a multi-step income statement because I split my expenses into two types. So what I want to know, let's again assume that I buy t-shirts and I sell them. So if I sell my t-shirts for $15 and I sell 10 of them, my sales are $150, and I want to subtract, if I buy them for $10 and I buy 10 of them, I want to know what I'm making on t-shirt sales over the cost of my t-shirts. So if this number is negative, my business is in a lot of trouble because I'm not even covering the cost of the merchandise that I sold. So, so in this case, I've made $50 on my t-shirts. But I know that I have to pay advertisers, I know I have to pay accountants, lawyers, the president of the company, etc. So everything else is down here. And the only reason I have this multi-step income statement is so I can compare one merchandiser to another merchandiser. So it would be interesting to, if I had another merchandiser with 150 there and then 120 here, my comparison would be, you know, this one makes more money off of their t-shirt sales. So the only reason I have the format of these income statement is financial statement users, investors, and creditors have said they want it, and they would like the expenses broke out into two. So you need to know that. Okay, there's a much longer one, but if you notice, they just break out all my other expenses. We call them operating expenses. Notice your other expenses includes income tax, but we also subtotal before income tax. So a lot of times you can see I erased that. I had operating expenses there first. There's even a longer income statement, but for our purposes, we're going to go with this one. Some people call these operating expenses. You always subtotal before tax because, again, investors want comparisons and taxes always affect businesses so differently that they want a subtotal before tax. You can read through that. Okay, next item that we're going to talk about are subsidiary ledgers. Subsidiary ledgers, so let's talk about Quincy University. Quincy University has accounts receivable from students. So if I send out bills at the 1st of August or mid-July or the start of July, etc., I have accounts receivable from students. But I need to know how much each individual student owes me. So even though the financial statements might have accounts receivable students, I have individual subsidiary ledgers for every single student. So if I had 5 students and each of them owed me $100, I had to have student 1, $100, student 2, $100, etc., etc. So subsidiary ledgers are just the detail that make up all of the information. So again, each of you is a subsidiary account for Quincy University. If Quincy University buys paper from a paper company, the paper company keeps track of Quincy University's individual bill. Also, so they're a subsidiary ledger. Inventory, we keep subsidiary ledgers on inventory because we need to know specifically which items of inventory are there. So anyway, so the subsidiary ledger, we don't use a lot. You can see over here, it was Okawa Wholesale Company, so I put OWC as to indicate that that's accounts payable to the Okawa Wholesale Company. But other than just putting it in notations or a dash, we usually don't use subsidiary ledgers in accounting. What happens on a computer is if I credit accounts payable, what happens is it pops up and it asks you the question, who? And so you would enter in their account number so you can identify who owes you money or who you owe money to, etc. Okay, so notice this is Sparks and Heather Jacobs, and so we only have 2 accounts receivable. So we only have 2 customers here. One is Sparks and one is Jacobs, and you can have hundreds and hundreds of subsidiary ledgers. Okay, inventory subsidiary ledger lists each item of inventory, fixed asset subsidiary ledger, and it has each fixed asset, etc. Cost flows. What happens when you buy inventory is when I buy inventory, let me see if I can find an entry, I put it on the balance sheet as an asset. And so then when it's sold, it gets moved to cost of goods sold. So what happens as far as the cost flows here, first it goes into inventory, and it sits into inventory until it's sold, and then when it's sold, it's moved to the income statement into cost of goods sold. So it's important that you know that right there is an asset. It's something I have, a future benefit. And then it's moved into cost of goods sold as an expense. So you studied in last chapter, and a lot of you wrote a answer to a forum question. What about, why do we make adjusting entries? And we do adjusting entries for the matching principle, so our revenues and expenses are matched with the period they pertain to. So this sits into an asset account until I record the revenue. You're going to see that over here. I record the revenue when I sell it, so therefore I have to record the expense. And again, cost of goods sold is an expense. So I record, sits in an asset account until it's gone. When I sell it, I match the expense with the revenue. And that's just a diagram. Okay, there are two approaches to inventory. Generally speaking, it used to be before computers, so probably 30 to 40 to 50 years ago, periodic systems were quite common, because especially for small stores, because computers weren't available and weren't affordable enough. So you kept periodic inventory systems. Now we keep perpetual inventory systems. Perpetual inventory systems are when you have a computer and you keep track of each individual item perpetually. So your subsidiary ledgers for inventory will always tell you how much is there. So for instance, it used to be when you ordered something out of a catalog, you sent in an order form, it went to the company, they had to go and check to see if they had it. Once they checked to see if they had it, they would reply to you and say, you know, they either had it or they didn't have it. Now perpetually you can go online, and if you bought a pair of shoes, it even has grayed out the sizes they no longer have and highlighted the sizes they do. So in the computer they know exactly how many style and what sizes of inventory they have. Periodic, you go count it at the end. Now there's a lot of times where you still use periodic inventory systems. Let's say for instance you have a barrels and bins candy store, and it's a one-room candy store, and you have clear plexiglass cases for your inventory. So if I'm selling gumballs or Jawbreakers or Starlight Mints, a lot of times you can tell how much you have more quickly by just opening your eyes and focusing them in the direction of the clear bin, and you can see how much is in there. So you can periodically take inventory, and if you bought 1,000 of them and you have 2 left, you know that you used 998 Starlight Mints. So you do it periodically. Okay, so this is perpetual, etc. Okay, so we're going to go through these, and I have 2 columns on this handout because I'm going to skip through the slides that do the periodic later because I want to do them side by side. So in a perpetual inventory system, we perpetually keep track of the inventory we have. So I'm going to have, when I purchased 10 21 computer monitors from Okawa Wholesale Company, the monitors cost $600 each, so 10 times 600 is 6,000, payments due in 30 days. So under perpetual system, I put them in inventory, and then I actually have a subsidiary ledger for the 10 Regent 21-inch computer monitors to identify which ones they are, and I have accounts payable. However, under periodic, I only, it's kind of like the supplies and the adjusting entry. So if I keep buying, you know, let's just imagine your pantry with flour or sugar. Okay, so you buy it, you throw it in the bin. How do you know when it's gone? Because you look in the jar and it's gone, and then you buy some more. So if you bought a 10-pound bag of sugar, for, let's make this simple, for $10, and you put it into your account, and then you looked at it and it's gone, you would say, I've spent $10 worth of sugar. So what happens at the end of the financial statement period, before I make my financial statements, I go count what's left, and whatever's not there has been used. So I'm going to force it into an expense. So you're going to find out I need to adjust it to the count at the end, and I'll get to that in a second. So what's kind of unique about periodic inventory is I do not have, during the year, I only have them at the end when I force the balances. I don't have an inventory account. and I don't have a cost of goods sold account. Okay, so during the year I do not have it. At year end, I'm going to force them to their correct balances. So this one, I have inventory and accounts payable. Under periodic inventory, I put it into purchases. So I have 6,000 into purchases, I have 6,000 into inventory. So right now they look exactly the same, like they're no different, except I call one purchases and inventory. However, when I sell inventory under perpetual, you always have two entries, because I tend to want to sell it for more than I paid for it. So I need to have one journal entry that accounts for the sale, and one journal entry that says, all right, the inventory is no longer here and I need to move it to an expense because my expense needs to match the same period as I have my revenue. So on September 7th, they sold 2 computer monitors for $1,000 per unit on account, etc. So under the perpetual side, I have 2 journal entries I'll show you over here. I debit accounts receivable and credit sales. That's what I sold it for. That's how much I'm going to collect from my customers. So I sold them for 2 for $1,000, so that's $2,000. And then I'm going to move, notice this is 10 at 600, I need to move 2 computers at 600 out of inventory into cost of goods sold. Alright, so if I went back up here to my income statement, I have sales of 2,000, cost of goods sold of 1,200, 2,000 sales, cost of goods sold of 1,200. Gives me a gross profit of $800 on those computers, which should make some sense because I sold them for $1,000 and they cost me $600, and so I made $400 on each. Okay, so that's when I sell. Now under the perpetual, again, remember I don't have an inventory or cost of goods sold account, so I can't have a cost of goods sold, I can't have inventory. So what happens is I just have the first entry. Now remember, at the end of the period, I'm going to go out and count it and force the correct balances into inventory. So far, right now under the perpetual system, I can see that I have inventory of 6,000 minus 1,200, so I have inventory of 4,800. And over here, I really don't know how much I have on hand. So when we get into internal control and trying to prevent theft and checking for theft, you can see that on September 7th, I could go out and count my computers, and there better be 8 out there, because I bought 10 and sold 2. Under a periodic system, I don't know how many is supposed to be out there. So this one has better control. All right, next one, they paid, we got paid for it, so, I'm sorry, Computer City, we're Computer Cities. Half the time in these problems, you really need to try to get your mind wrapped around which company you are. So in this case, Okawa bought from Computer City. I will tell you this is a little bit unrealistic because you tend to work for a company, and so if I worked for the company, I would know which company I'm making the journal entry for. But anyway, so we paid them. So we have Computer City paid Okawa Wholesale $6,000 for the purchase. So we are Computer City, we purchased them, and then we paid for them, okay? So I need to get this, I have accounts payable of $6,000 on my books up here, and I said I owe them, and now I'm paying them. So I debit my accounts payable to get it off my books and credit cash. And since under the periodic system, I only don't have inventory and cost of goods sold, my entry is the same. This one, Computer City collected $2,000 from RJ Travel Agency. So notice I sold them to RJ Travel Agency here, and I am to receive $2,000 from RJ. So I credit that because they paid me cash. So I debit cash and credit accounts receivable. Again, over here, the only accounts these don't have are inventory, cost of goods sold, so it's the same entry. Next one. Now, under a perpetual system, I should have $6,000 minus $1,200, so $4,800 of inventory on hand. Now, notice in this particular problem, I could have backed up and I've got inventory from prior months, etc. So if I started business today, I have $4,800 of inventory on hand. If I've been in business for a while, I might have inventory balance left over from prior period. But anyway, so remember the definition of an asset is a current or future benefit. So what we have to have on our balance sheet is the amount of current or future benefit we're going to get from inventory. So if our inventory has disappeared, we cannot leave it on the balance sheet. That's called fraud, because it would be saying we have inventory that we don't have. So what I need to do is go count it at year end and force it to its correct balance. So notice I've lost $2,200 of inventory, so hopefully I've got more than $4,800 of inventory on hand, and I didn't just start a business, because I would be really short. But anyway, so, and quite frankly, usually we force it to cost of goods sold. Sometimes if it's a huge amount, we'll have a theft loss or a fire loss, etc. But we usually call inventory shrinkage a normal part of doing business. So I'm not talking about a major flood loss. I'm not talking about a major theft. I'm talking about that breakage, spoilage. So obviously, if you add a few zeros after this, maybe it's 600,000 of inventory and I lost 2,200, and you're selling something like lettuce. We know that lettuce spoils, so we tend to know we're going to lose it. We know that sometimes things are stolen, and we take that risk because we want to sell to the public and we don't want to frisk everybody as they go out of the store. So we know there's a normal part of that that's theft. And notice where I put it in. I put it into cost of goods sold. And the example that I like to say about cost of goods sold is, let's pretend I'm going to go away from a merchandising one to a manufacturing to see this. But let's say you needed to make 2,000 cakes. And to make 2,000 cakes, you needed 2 eggs each, so you needed 4,000 eggs. How many eggs would you buy? And most of you wouldn't buy exactly 4,000 eggs. You would buy 4,000 eggs and a couple dozen more, 4 dozen more, etc., because you would expect to lose some. So what happens is, let's say I bought an extra 100 eggs. So you would say the cost of making 4,000 cakes includes 4,100 eggs, because that is part of normal. And I want my cost of goods sold to include normal spoilage, breakage, theft, etc. So what I do is I get my inventory down to its correct balance and throw it into cost of goods sold. Another way you could view this as, let's say that I am selling something where I just take scoops and I just kind of guess the amount because I think there's 10 in it, and a lot of times I just give 12 and charge them for 10 to make a baker's dozen in donuts. Maybe they sell 12 but charge you for 12 but give you 13, and so but in that case I'd probably know and adjust my cost of goods sold for it. But anyway, it's as long as it's normal, I take it through cost of goods sold, because normal breakage, spoiling, theft is truly part of the cost of selling the good units. Okay? Over here, I don't have an entry because I don't know how much I should have on hand. Okay, so closing entries, I'm not going to go through these because I just closed revenues, and my revenues include sales, and my expenses include cost of goods sold. Periodic inventory system, I periodically count it and adjust my records to what it should be. So think of the supplies. So if I gave you 2 pencils, if you started the semester with 2 pencils, and you bought 7 more, now you have 9 available. If you ended up the semester with 3 left, you can say, hey, I used 6, because you backed into it. And that's exactly how we do periodic inventory systems. Okay, so notice it goes to purchases rather than inventory account. When I sell it, I make the entry for sales revenue, but nothing to cost of goods sold, and the inventory records are not updated. And again, a lot of times you do this just simply because you need a computer to do perpetual, and you don't absolutely need a computer. So for instance, if I was going to sell priceless art, I would keep track of them by hand, and make sure that I did perpetually knew what I had on hand. But I'm talking about, you know, if you think of the example of the candy store that I gave you earlier. Okay, the physical count determines the inventory at the end of the year, and then I back into cost of goods sold. Okay, so we've already done these, purchases, accounts payable. Okay, so let's go down to this one. So determine the cost of goods sold. So notice that my numbers are different. So again, this is just 1 or 2 entries for the month, but through the year I've got a whole lot. Okay, so how do I determine? I do a cost of goods sold statement. So I'm going to determine cost of goods sold if beginning inventory is $14,000 and purchases are $130,000 and ending inventory is $12,000. So let's go back to the example I just told you. Let's say you started off the semester with 2 pencils and you purchased 7 more. That gives you 9 available and you had 3 left. So how many did you use? 6. So let's put accounting terminology to that. The 2 is beginning inventory. My 7 is purchases. My 9 is available. My ending inventory is 3. So how much I used, or in this case, cost of goods sold, is 6. And so I'm going to do the same thing with my periodic inventory statement. I wish they didn't both start with P. So I have beginning inventory of 14. I have purchases of 130. So I've got 144,000 that is available during the month. I know I go out and count it and I find that there's $12,000 worth left. And so my cost of goods sold is 132,000. I back into it. So remember though, on an income statement, I need sales minus cost of goods sold is gross profit. And on a balance sheet, I need inventory. And I don't have those. So how do I get those? So what happens is I do some closing entries to force them to the correct balances. So the first thing that I do is I pretend I've sold everything available, which is wrong, guys. So remember that. So I move them out of my beginning inventory is sitting from inventory from last year. You're going to see that right here in this second entry. So my beginning inventory is 14,000, which was this entry last year, right there. And so I credit inventory. Remember, inventory is an asset account. So if I have a debit of inventory of 14,000, okay, and this is inventory. So if I want to get it to 0, I credit it. So I'm going to credit inventory for 14,000. It's that number. Then I have purchases that I've just put in of 130,000. In my particular case, I've only made an entry of 6,000, but this is just one entry the entire year. We've put in 130,000. So I credit purchases. So notice it was a debit up here. So now these 2 accounts are 0 and cost of goods sold has 144,000 in it. Okay? But now obviously that's too much because I haven't sold some. So there's only 2 things that can happen to goods. It's either sold or not sold. So I'm going to take out the portion that's not sold and throw it back into inventory. So now if you made a T account of cost of goods sold, I remember it's an expense. So I debited it for 144,000 and I credited it for 12. So I net the 2 and it now has 132,000 in it. So there's your journal entries for your periodic system. And this just kind of shows how you do it. Again, the closing process, sales is a revenue account, cost of goods sold is an expense account. You close all your revenues, close all your expenses, close income summary, and then close dividends. Just like the prior chapter. Okay, I'll let you look on when you would choose an inventory system. But basically, if you have very high dollar items, you want a perpetual system because I want to keep track of my Monets and Renoir and Degas and any other precious art that I have. So I certainly want a perpetual system, even if I do it by hand. But if you have, you know, like Starlight Mints and very high volume, low cost item, I can't perpetually keep track of how many I have. And so you can kind of go through that. And the next thing that we're going to talk about is discounts. You can get discounts for paying early. So this is when I buy something, and if I buy it on discount, this means I will get a 2% discount if I pay within 10 days. Otherwise, the net is due in 30 days. So if I buy $100 of inventory and I pay for it in 10 days, I get to pay $98. So that's a cash discount. Those are credit terms. And you generally write these underneath. You can have 115 net EOM for end of month, net 15, etc. So this is the information there. Okay, so we're going to go through these, and we're also going to do the gross and the net method. This handout does the net, so that's this column. I'll do the gross at the same time. So we purchase 100 spreadsheet programs for $100 each, so 100 times 100 is 10,000. Credits 2/10, net 30, prepare the journal entry. So I'm going to do the gross method first. So 100 times 100 is 10,000. So notice we purchased them, we didn't sell them, so make sure you pay attention to that. So I debit inventory, credit accounts payable. All right. If I use the net method, I record them at net of the discount. So if I get a 2% discount, I'm going to pay the other 98%. So if you feel better about it, you can take 10,000 times 0.02 and subtract it from 10,000, or you could just take it times 98%. So I'm going to debit inventory and credit of accounts payable for $9,800. Then, when they pay for them, I'm going to go on this column. I'll go to this column first. So if I pay for them and I make the 10 days, so I only pay $9,800, what happens here is I need to get the accounts payable off my books for the total amount. Because after all, if I said when you bought something for $10,000 and I said, hey, if you pay me $9,800, I'll call it good, and I only debited $9,800 into accounts payable for you, you'd get a bill that says you owe $200 and you wouldn't be very happy. So we always credit accounts payable for the amount of the bill that's going to be gone. And then I'm going to credit cash for $9,800 because we paid $9,800, and that difference is purchase discounts taken. Over here, since I paid $9,800, I simply get the accounts payable off my books and credit cash. So what happens if I don't make the 10 days and I don't take the discount? Well, over here, I do the same thing, get the accounts payable off your books and credit cash, and they happen to balance because I had to pay all $10,000. But over here, I say, let me get the accounts payable off my books, which is $9,800. I now have to pay $10,000 cash, and we call this purchase discounts lost. Okay? The only thing I would say to you is, well, we'll get to it in a second. Okay, now assume we did that. It's over here. On November 3rd, they purchased $10,000 again of merchandise on credit. Didn't make that one. That's the gross one. We've already done that one. Purchase discounts taken. Okay, and that one. Okay, so we did these three. Sorry about that. Okay, on November 9, they returned $500 of unsatisfactory merchandise purchased from PC. 210 net 30. Again, you're going to do this differently if it's the gross method or the net. So notice they returned $500 of inventory. So if I've recorded it gross, I can just get, notice this is my entry when I buy. So when my entry when I return it, I just flip it for the amount that's returned. So I credit instead of buying it, debiting inventory, crediting accounts payable. When I return it, I credit inventory and debit accounts payable. Now, if I've already paid off the bill, like it looks like I'm up here, then you can debit cash or accounts receivable if you need to get a refund, etc. So just pretend this is separate from these, okay? However, under the net method, I put it on my books for 98% of face, so I need to take it off my books for 98% of face. So 500 times 0.98 is 490. Then, this one's not on slide, and we're going to talk about freight in a second. If you have to pay freight to get it there, freight is added to the cost of the inventory, so I'll debit inventory and credit cash and do the same thing over here. I will just warn you, sometimes you might want to put freight after it because you don't often get a discount on the freight. So if I added it all together and I computed my discount, make sure you don't compute the discount on that $300. Also make sure you don't compute the discount. Here, I've got it there. Do not take a discount on freight or return merchandise. So I only get to get a discount on the inventory itself that I kept. Okay. So transportation costs are part of the asset being acquired. We already talked about that. Okay, so now we're going to do sales. So notice this was the purchaser side of it. Now I'm going to do the seller side of it. Okay, so whenever I have a sale, I have two entries. So we're going to assume the perpetual, not the periodic. If you want the periodic, you go back up here. I do purchases. We're going to do this column, the perpetual. Okay. On November 3rd, they sold $2,000 in merchandise to Highlander Pub. Credit terms $210, net $30. Computer City originally paid $1,200 for the merchandise. So whenever you have a sale, you have two entries: accounts receivable, sales, cost of goods sold, inventory. So I put them side by side because I didn't have enough space. Okay, so I sold it for $2,000. So I have accounts receivable, sales. The amount I'm going to collect is $2,000. The amount I want on my income statement for sales is $2,000. But the merchandise cost me $1,200, so I'm taking it out of inventory with a credit. Inventory is an asset, so I credit it. And I put it into cost of goods sold, which is an expense, with a debit. So again, I made $800 on this. Sales minus cost of goods sold. Okay, next one. What happens if then they returned it? So basically what we do is we flip these two journal entries with a little bit of an exception. Okay, so I'm going to debit sales, returns, and allowances and credit accounts receivable. So I'm going to flip this, but I want to keep track of how much is being returned. So I alter the account slightly by calling it sales, returns, and allowances. Okay, this is a contra revenue. So notice sales is a revenue. So this is a contra revenue. What a contra revenue means is I will net it against my revenue. So I will say my gross revenue here is $2,000 less my returns and allowances of $1,000 gives me my net revenue of $1,000 less, the other $1,000. Okay, so the only reason I do this account right here is because I want to keep track of it. And whenever I want to keep track of something, I put it into a separate account. Okay, so I'm going to flip this in for the amount returned. And I'm going to, if I put it back on the shelf, by the way, if it's damaged or I tell them to throw it away because I can't take it back or something, I would not flip this one. But assuming I take it back, I need to put it back into inventory for what I purchased it for. So notice this, sometimes you have to do a percentage. This one is, I returned half the merchandise, so I got half of the inventory back. So half of 2,000 is 1,000, half of 1,200 is 600. Sometimes you can do a percentage, so 1,200 divided by 2,000 is the cost is 60% of what I sold it for. So if it's 1,000, I take it times 60% and I get 600. So anyway, so make sure this is less than that, and it needs to be in the same ratio here. Next one. Okay, fine. Now, what happens when they pay for it? So again, make sure you don't pay for something you didn't keep. So first, look at accounts receivable. I put in $2,000 in the debit side, then I credited it for 1,000. So right now, in my T account for accounts receivable, I've got 2,000 here, but then I returned 1,000, so I don't owe that. So my balance left in accounts receivable is $1,000. Okay, so again, I don't collect on things that were returned to me. So look at their bill. Their bill is 1,000 left. So I get the remaining accounts receivable off my books. Then I ask myself, did they get the discount? And if they made the 10 days, November 3rd to November 10th, that's 7 days, so I made the discount. By the way, I'll never put one on the 13th. I didn't get you confused. It's the 13th, the 11th day, or the 10th day, but anyway. So I take 2% of 1,000. 2% of 1,000 is $20, so I got cash of $980, and a sales discount is $20. So make sure you spend a little time asking yourself, okay, did we sell it or did we buy it? Because if you sell it, it's a sales discount. If you buy it, it's a purchase discount. So make sure you call them the right thing, because purchase discounts are netted with purchases or inventory, and sales are netted with sales. Okay, just a few other things on here. Oh, not on the slide. Delivery expense. So in delivery expense, if Computer City paid shipping. So if Computer City is the seller, when they pay shipping, it's called transportation out or freight out. Transportation out and transportation in are two completely different things. So when we buy inventory, not sell it, when we buy inventory, it's freight in, obviously. Freight in gets added to the cost of the inventory, and when I sell my inventory, it goes through cost of goods sold. Freight out is a selling expense. So most of the time, inventory is sold under freight in. So if you've ever ordered anything online, you pay for the shipping. How do you pay for the shipping? They add it to your bill. So if you think about, okay, I bought a pair of tennis shoes for $100, and they charged me $6 of shipping, your tennis shoes really cost you $106, and I think your mind says that. Now, when does the tennis shoe company pay for the freight? Well, they pay for the freight if you order over $300 of items, or if you buy it on Black Friday, etc. In other words, freight out is a selling expense, not a cost of the inventory. So the seller's paying it, so it goes into other expense. So make sure that, you know, pay attention who's paying the freight. If it's delivery expense and the seller pays it, it's freight out, it's part of that. If the buyer pays it, it's added to the inventory. Okay, and then the last thing that's in here is sales tax. Sales tax, basically stores have to collect sales tax and send it into the government. Or to the state. So it's not ours as a revenue. It's just really a pass-through. So if you look at it, we had $1,000 sales subject to 7% sales tax. So the person handed us $1,070, but the sales is only $1,000, and I have to pay $70 to the state. So I hope that helps.